Hello everyone, and welcome to our in-depth economic analysis bulletin. Today, we will unpack an event that is shaking the financial markets and casting a shadow over the prospects of global recovery. Recently, the United States received some grim news regarding inflation, especially in the context of increasingly complex geopolitical turbulence. Inflation in the world's largest economy recorded a massive surge this past March. The most prominent and direct cause pointed out by analysts is the conflict in Iran, a dangerous spark that has directly driven gasoline prices to sky-high levels. How bad is this inflation picture? Let's dive deep into the figures from the Bureau of Economic Analysis under the US Department of Commerce, a report just released on April 30th. Official data indicates that the Personal Consumption Expenditures Price Index, or PCE for short, jumped 0.7% last month. If you are not familiar with these indices, a 0.7% increase is not a typical fluctuation.
In fact, this is the sharpest increase recorded since June 2022, following a 0.4% rise in February. These numbers, while shocking to consumers, perfectly match the previous forecasts of economists. When we widen our perspective to the 12-month period ending in March, the PCE index surged to 3.5%. Once again, the chart sets a new peak, as this is the largest increase since May 2023. For comparison, just in February, this figure was sitting at 2.8%. This crucial data was included in the advance report on Q1 US GDP that was recently released, after the Bureau of Economic Analysis finished updating the data following delays from the US government shutdown last year. However, if we solely blame the current conflict, the economic picture would lack comprehensiveness. Reality shows that inflationary pressure had been simmering and at a high level even before the war broke out. The underlying cause stems from the extensive import tariff policies implemented since former President Donald Trump's era. When the war in Iran erupted, it acted as a final blow. Data from the US Energy Information Administration reveals a harsh reality. Average retail gasoline prices across the US skyrocketed by 24.1% in March alone. Gas prices at the pump have continued to climb relentlessly and hit their highest level in nearly 4 years as of this week. Now, let's break down a more foundational indicator, the Core PCE Index. Core PCE is an inflation measure that excludes food and energy prices, two commodities that are inherently volatile due to external shocks. In March, core PCE rose by 0.3%, and over a 12-month period, this figure stood at 3.2%. Ladies and gentlemen, core PCE is the very inflation gauge the US Federal Reserve, or the Fed, pays special attention to in pursuit of its ideal 2% inflation target. Faced with immense pressure from rising inflation fears due to the conflict, the Fed had to make an extremely cautious move. On April 29th, the US Central Bank decided to keep its benchmark interest rate unchanged in the range of 3.50% to 3.75%. This decision was not entirely unexpected, as the worsening inflation situation solidified the financial market's belief that the Fed might have to maintain these high interest rates well into next year. So how do all these dry percentages actually affect the lives of the American people? High inflation directly boosted consumer spending in March. Consumer spending, the main engine accounting for more than 2/3 of US economic activity, surged by 0.9% after a 0.6% increase in February. Hearing this, one might mistakenly think Americans are flush with cash and spending more generously. However, the truth is quite the opposite. If we adjust that spending figure for inflation, real consumer spending only saw a meager increase of 0.2%. What does this mean? It means consumers are having to dig deeper into their pockets, spending more money just to buy the exact same amount of goods and services as before. Their purchasing power has not increased. This is clear evidence that consumption and the entire US economy are beginning to fall into a slower growth trajectory entering the second quarter. Looking ahead, the economic outlook still holds many dark shades. Economists have forecasted that the economic fallout from the war will become even more pronounced and severe in the coming quarter. The United States, and perhaps the entire global economy, will need to be ready with contingency plans for a challenging period ahead,
where the puzzle between growth and inflation remains unsolved. Thank you for tuning into our in-depth bulletin. Goodbye and see you in our next analyses.